All right, so everyone should be able to see my screen. Pretty much what I'm going to do, and I think this is going to be helpful for a couple reasons. One, because right now, just like usual, whenever I make a course at the start, it's text, images, and eventually I'll add in videos for each lesson just to kind of go along. It's going to be explaining the same things, but I know like some people enjoy the video format, so we'll do that as well soon. But right now it's just text and images, so this will be kind of the opportunity to talk through it. If we have questions along the way, I'm going to kind of explain each section or lesson and then look at the chat on the side. And then once that's cleared up, move on to the next. Just because if there's any questions that come up, great, I'll answer them. And it also gives me a good gauge on if I need to make adjustments, because these are never perfect right off the start. We're always kind of tweaking them or adding things that need to be there over time, because that's just how things are, especially when there's such a big piece of work like this. There's going to be something missing. And then the same goes for if I make a typo or I maybe forgot something at a certain area. I'm going to notice it when we go through this, because like I said, there's a lot in here. So there's a very high chance that there's something off, and I'm probably going to catch it along the way. So that'll be helpful as well. So yeah, we'll pretty much get into it. And this here is going to be pretty much foundation model, protected swing in one course, kind of bringing them together, and then also refining a couple steps, more so to make it easier to follow along with, getting you to the same spot, the same conclusion, just in a more direct way. And then also getting access to new data. That changed some of the way that I'm approaching things, because data, when you get access to that you didn't have before, certain assumptions that you may have had before, they change because you just can't go against data. That's what it tells me. So some things were adjusted, especially here in the economic calendar. And that's what we had here as well, where this is pretty much the overview of each section, kind of what I just explained here. And these are the 6 sections: economic calendar, price signatures, caution protocol, actionable market, intraday confirmation, and then trade management. And then these are the things that I will eventually add in as well that I know at the moment. There will be a section for trading the invalidation, which I know is a topic that is relevant because it presents trade opportunities. So that is going to be added here, and it's going to be pretty straightforward when it's involved in all of these things here, and you'll see why. And then of course videos that will go in there, and then quizzes at the end of each section, because I think those are really good, because it kind of makes you reflect back on what you read from before. And another thing you might notice is, instead of sectioning the names or naming the sections as something like weekly profile, price delivery, daily profile, it's in the actual, like, what are you doing in this step of the model? This here, the confirmation, the management. So it should be a little bit more direct in what you're actually looking to do in each part of the model. And that'll bring us into the first section here, which is the economic calendar. I am going to go through most of these, just even though most people already know these things, but I'm going to go through it anyways. This is the same, very similar as before, the calendar settings. You all know this link will take you to forexfactory.com as you go through it. When you first open up forexfactory.com, it's going to look like this when we put all of these filters on. This is what it's going to look like. And of course, this is not what you want. It's extremely overwhelming. There's news events on Sunday. Like, there's too much going on here. Most of these events, especially if you're trading a specific market, they mean absolutely nothing to you, and they probably won't even impact the market. So we can avoid and ignore most of these. This entire section is pretty much telling you, take off orange folder, yellow folder news. We only care about red folder. And then we can keep the gray folder on, because this is going to show bank holidays and certain, market closure dates that we want to be aware of. Currencies on the right, I will get to that, but we would clear those out, and we can keep all of these on. So just by doing that immediately makes it better. And if we go back, first one, remove orange and yellow folder news events. We're going to do that right off the bat. That's the first step. Choose currencies correlated to the market that you trade. And we have that down here as well. So this is some example of what you would be doing if you're trading indices. All you want are USD folder news. If you have Forex, choose the cross pairs. So if it's Euro USD, USD, of course, and Euro as well, GBP USD. You see the trend there. That is what you would be doing. And then commodities are an interesting market where, gold and oil, I would be aware of USD news just because overall that's more significant in my opinion, but the impact is rarely very direct on the market, where some event may be at a specific time, but these markets may not always see it on a consistent basis. So these are a little bit outside of the scope of things, but I would only be focused on these as well. Indices and Forexes are very direct in the way it will impact the market. So I would go to the filter, I trade indices. So the only one I care about is USD. I would apply that. And now I have my economic calendar for any given week. And I like to have it in the weekly view. So this week, not really in month or yesterday on the daily basis. I like to view it on the week. And that's pretty simple. Everyone pretty much understands that. This is what your economic calendar would look like at the end. News protocol. This is where some things have changed slightly. So make sure we're good. Rules around the economic calendar. This is where you'll be learning the refined approach, which is slightly different from before, only because of data that I was given access to around the economic calendar, mostly in relation to high impact news, because before, as most of you know, I was always avoiding pretty much the day before high impact news, things like NFP, CPI, FOMC press conference, because they are highly integrated into the market. The market cares about them. And oftentimes my assumption was that would have a really great impact on the previous day, making it more ranged or less likely to expand. But I'll explain why at the end, it's at the end of this section or a lesson where that is explained. But the rule now is avoid opening any trades, any session prior to a high impact news event. So intraday, let's say you have NFP tomorrow as an example, NFP at 8:30. I would not be opening any trades prior to 8:30, trying to maybe scalp the London session or doing anything like that. It's not really of my interest, and that rolls over into the next rule, where you wouldn't position yourself in the overnight session prior to the event, because there's no holding a position through a high impact news release. That's never going to be something that you will ever find me doing. These are things that you can't predict. And most of the time, if you are trying to hold through an event like this, you're going to get either stopped out, or in the case that you're wrong, which is very possible with things like this, your stop can get slipped. You lose control of risk management. This isn't just, if we want to be consistent, we're never opening trades or holding trades through high impact news releases. That truly will never change. Of course, there's going to be times where you're applying that rule and the event maybe does what you want, or the volatility is low. That's just over time. We want to be avoiding this. And I think everyone here understands that. And then the other thing is just be aware of other news drivers on days that are being entered on. So that's what you'll see me do when we're going over the economic calendar like this here. I'm going to first look out for high impact news events. NFP sticks out to me immediately. I'm aware of this because I have to go into tomorrow actively saying I'm not trading before 8:30. I'm not holding a trade through 8:30. That is a rule, a strict rule. Doesn't matter what the market's doing. But outside of that, I'm going to be aware of these other events on this filtered out economic calendar, because they are going to bring volatility into the market in some way or another. And I compare that alongside with entries. I could say maybe this daily profile or this entry is not completely there, or the framework is slightly off. I want to wait for this volatility driver to come through for better confirmation or more narrative. That is what you can do with that. So you want to be aware of those times, because 8:30, if there is no news event there, it's not a volatility driver. So we want to know that is existing. So for example here, this type of economic calendar, Tuesday CPI, no holding trades or no opening any trades intraday session prior to 8:30 on Tuesday. No holding trades or no holding open trades through 8:30 on Tuesday, because it's high impact news, CPI. And then the rest is just being aware of 8:30 on Wednesday, 8:30 on Thursday. These are, medium impact, low impact that we don't have to be completely concerned with, but we want to know that they are there because we can pair them with entries. And this is the data that we were seeing which is changing that rule for me. Day, this was over a couple. It was holding consistently over the years, but this is specifically from this year just to match the volatility of what this year has been like, which is pretty high. But this was showing the average range of total trading days is 365. So if you take every day from this past trading year in 2024, the average is 365 from high to low, the range. And if we take every day before a high impact news event, which is still a pretty good sample size, it's 341. There's not really a significant difference here to really blame news as its own thing to say that this is impacting the daily range to that significance. And honestly, the only reason it's below that average is because this data set is taking in CPI on a Tuesday, which means it's counting in Mondays. And that was really the only significant outlier. And since that's included in this data set, it's going to knock this number down. Day before NFP and day before CPI were actually on average greater than this number here. So there's really not enough there for me to say I have to continue avoiding that trading day. And that's enough for me to move out of that rule. And that's why it's like this in the course, just backing up with what is the data telling me to do. And then just off the bottom here, high impact events are mentioned in this lesson. And these are the three that you have to worry about. Everything else can just be applied as understand that it's in the economic calendar. Moving on, this is a very simple section, and I've talked about this in the past. A common mistake with the economic calendar or some expectation is that when we have an economic calendar that looks like this, there's news all throughout the week, and it's looking like, wow, this could make a large difference, or this week is going to be the best week of my trading career. This doesn't necessarily mean that the market is, one, going to offer great opportunity, or two, is going to make significantly large range moves every single day. That's just not the case. And on the other hand, when we look at something like this, this is a real economic calendar. This year, when we see one news event on the week, it's lacking in any red folder events. This does not mean the market is guaranteed to consolidate or can't offer large range moves. It's just that there's no real protocol around the economic calendar, and all I need to know is 8:30 on Thursday will bring some volatility. And that's just something to avoid, and not just assume that something like this means large expansions are coming and something like this means the market's going to range, because that is not the case, and it does not hold up over time. I think most people are probably pretty comfortable with understanding the economic calendar, but if there was any questions, I would look at them. But I assume most people are pretty on track with this, and there's nothing too crazy there. The only difference was the news protocol, but you saw the numbers as well. So moving on to price signatures, this is what I was saying. I don't know if it picked up or not, but I'll say it again. This here is not really an actionable step in the model. These are just things in the charts that we have to understand because they come up again in other parts of this model here. So these are just the basis of certain price concepts, which most of you, I'm sure, already understand. But again, just like the economic calendar, I'm going to walk through it. So failure swings, that's the first thing. That's the concept of basically areas in the market which are lacking reversals, and we are usually using them as areas to draw into, and we're not interested in trading away from them. So a failure swing is basically like shown here. You form an initial low, and instead of reversing off that low, we trade really deep back into that while not going all the way through it and then starting to trade away. In the same way, a failure swing high, we form an initial high. We don't fully reverse from it. We trade really deep back into it without taking it out and then start trading back away. That forms a failure swing where we're not really interested in trading away from these points. And it's a pretty simple concept. And when we have a failure swing, the relevant point that you're looking at, you're not worried about this here. You keep looking left because that is just a failure swing to this initial point that was formed in the market. That is the area of focus on the low. That is the area of focus on the high. Not this high here, not this high, not this high. Look all the way left. And that is where your point of focus goes when there are failure swings in the market. And with these price signatures, this applies across pretty much all time frames. False failure swings, this is where we bring into potential divergences, where when you look at failure swings in the market, we have, let's pretend you don't see this here and you don't see this. On one pair, you see potential failure swings. So off the lows, failure swing, off the high, failure swing. The first thing you want to do to actually make sure that these are true failure swings, because this is going to change how you approach this market, you want to look to a correlated pair. So if you're on ES, you're seeing failure swings in ES, go to NQ. Make sure that there are also failure swings at that same point. If you're trading euro, look at pound, which is correlated, or look at dollar, which is inversely correlated. If you see something like this where, okay, I have my failure swings, potentially I'm going to trade align with that or understand that that's there. But then I look to, let's say, ES to NQ, and oh wait, it's not failure swings on NQ, it's actually a manipulation. This is not a failure swing. This is a divergence, which we could actually trade away from just because we have a manipulation on NQ as well. So that changes your approach. If you look off the lows, for example, one pair is a failure swing, the other is also a failure swing. That is a true failure swing because they are both showing that there's no protected swing from that point, and that would be an area you would want to trade into and act as a draw. That's pretty much the first thing you're always going to do. And then you have a little brief description of what the purpose of failure swings are, which I pretty much just went through there as well. And now we have the opposite of failure swings, where this is pretty much used as a draw, versus protected swings are going to be part of framework where we're going to look to trade away from these areas. And this here is really just manipulation or a divergence, which we kind of got into right there. And again, most of you probably understand this already. Manipulation is going to occur at relevant highs and lows in the market, and we will get into this, what is a relevant high or low. But we have a low in the market, and we would expect some form of manipulation to take place there. And we go down the line. Manipulation is basically the start of a protected swing, because whether it's a divergence or just a manipulation, it's there either on one pair or another. So this is really the basis of it. And this is an example. We have that low. It runs it out. It wicks above it. Sure, if a bias is bullish, that could be a potential start of a manipulation, but we need some form of confirmation to that to occur. This is pretty much like how it was in the protected swing course. You've probably seen this before. Low, a change in save delivery, the series of down close candles that ran into the low, that highest opening price, draw that out, close above that is a confirmation that this low does not need to be traded back to. And if the market's bullish, we would expect it to trade away from that point. This becomes a protected swing, and you're looking to trade away from that. That's your confirmation. And then an invalidation. This changed slightly from how I explained it before. In the last course, which I think could have been a little bit confusing, was it has to do, I think the way I phrased it was, it depends on the time frame being applied. The difference here is that, time frames can kind of overlap in certain areas. So this here, the way I'm explaining it is, it depends on the step in the model that you are applying. So if you're using it for a higher time frame framework, then you're going to use a close through 50%. So if you take the highest down close candle body to the lowest down close candle body, it's the opposite. If it were bearish, we're going to mark out 50% of that this here. And if you're using this as framework, so let's say this could be a daily time frame, then this would be a point of invalidation. If this could be an hourly time frame and a new day is opening, then this is acting as your framework, because on the higher time frames, since it's being used as framework, we don't want to see deep moves back through that point. We want to see the market be in respect to that and then trade away. And if we're using this as an entry, let's say this is a lower time frame, maybe you're on a 15-minute, your stop loss is always going to go on the opposing swing, not 50%. We're not putting stop losses internally. We're not going to try to jam our stop loss to make it smaller. We're always putting it on the opposing swing. And that's just really the main difference there. That's where your stop loss goes. That's the full invalidation point. Because when you commit to an entry, it can trade past 50%, and you're just going to continue allowing that to play out, because there's going to be plenty of scenarios where it does that, and then it starts trending back towards your objectives. So that's really the only difference with the invalidation. It's not, the difference is more in the explanation, not in the way you would be doing it. So pretty simple, 50% instead of the opposing wick on an entry. And then here with manipulation, we do expect this pretty much across all time frames. If we're finding a relevant level and we expect price to manipulate that, we want to see it happen fairly quickly and with some form of urgency. So when we see the market, if we're expecting this low to be an area of relevance or for price to manipulate that to start trading higher, and you see it, okay, initially closes below, and that depends on the time frame. If this is a daily, that is significant. If it's a lower time frame, then when you see it kind of taper off, it's not immediately reacting from that point. This is an invalidation of that manipulation. It's showing no intent to trade higher. Ideally, it happens quickly and it wicks that low or the high that you're looking to be manipulated. And that's just a general characteristic, but this will come up again more specifically in later sections of what you'd be looking for, because this does change slightly across the time frames. Divergence, this is pretty much the same concept that I explained before, where it is paired with the understanding of what a manipulation is. So for example, one pair, ES runs out a low. You look at that same area on NQ and it makes a higher low. Lower low to this, higher low to this. That's a divergence of correlated pairs. This still is a protected swing, and that would be on the pair you're looking at. This low does not need to be traded back to. And the confirmation on this, instead of it, because you don't have one pair is making a lower low, the one with the divergence, even though this is a higher low, we're still going to use this series of opposing candles to act as the confirmation, this close above. So that slightly varies from a manipulation, where you're going to look for that lowest low or that highest high, the series that ran into it. Because this is a divergence and a correlated pair ran through it, we can use this series here as the confirmation to this low being held, and that comes to this part here. In a divergence, this is not the protected swing. This here to the left is. So while one pair on the other would be this swing because it made a lower low, when you're looking at a divergence, if it's bullish, the lowest low to the left is the protected swing. If it's bearish, the highest high to the left is the protected swing. We don't want to use this one here. So if it's on an entry, we're going to use this as an area to be respected. If it's on framework, then we expect this low to not be traded back through. Opposing candles. This is more for when the market is in a continuation. So we've already formed likely a protected swing. We're trading away from it. The market is in that continuation. The general expectation is that pretty much across all time frames is that when the market is expanding and we have that expectation, opposing close candles, certain ones that are closed through, should hold price. So if you close above down close candles, when the market is expanding to the upside, those should support price. If you close below up close candles while the market is bearish and expanding lower, those should resist price once it closes through. This here. So we only apply this when there is a narrative for the market to continue or to expand in one direction. Closes through opposing candles mean nothing if the market is not expanding. You need that. It is an absolute necessity to start applying this logic. And the confirmation, similar to what it was before, the confirmation throughout that continuation. If it's bullish, down close candles, there can be series like this. Draw that highest opening price. If it's one candle, the opening price, we are looking for the close above that. If it's bearish, it would be up close candles. Look at the lowest opening price of the up close candles. If it's a series, look at the opening price of the up close candle. If it's just one and the close below is the confirmation to say that this should not trade back to that opposing swing in the continuation. And there's some just general rules to selecting the continuation, the opposing candles in a continuation. And there will be some more specifics as this gets into other parts here. But the general rule is that you're looking for either a series or a single opposing close candle that has a bulky candle body, but then also one that provides enough range where it will actually protect the opposing side once it closes through. So for example, this is valid, a series. So two down close candles, bulky candle bodies, it's providing a decent range. When it closes above, I would expect that not to return here. But when we look at 2, 1, the candle body is very small in relation to the candle, but also it's very small ranged. So once you get that close above, should you be confident that this should not be traded back to? Unlikely, versus when we see something like this, a single opposing close candle works. It's offering a good range, a bulky candle body, close through. Great. That's what we're looking for. And that's a general rule. There's other things that we're going to add in Confluence to this, especially with the entry part, which is always there. But this is just a general thing, and you want to just build your eye for this, and it's just pretty common sense. If it's a small range candle like this, a close through, why would it protect your stop loss if it's 5 points on NQ, 10 points on NQ? Like, that's just not relevant. Invalidation, this is the same as it would be for a change in state of delivery on a manipulation or a divergence. So when we look here, invalidation, there's opposing close candles. If it's a series, the highest body to the lowest, 50%. When we're using it as framework, equilibrium. When you're using it as entry in the continuation, your stop goes, or the invalidation is on the opposing swing. It's not at the low of the down close candle if it makes a new opposing swing. You look left, the lowest swing, and that would be your invalidation point, because that's where you're placing your stop loss. It's the exact same thing in the continuation for that there. So I assume that's pretty straightforward with price signatures. So I want to assume so, at least. So I'm going to move on to the caution protocol. So the way that I restructured this a bit is thinking in terms of when should I not participate in the market. So if you know when not to trade, then you pretty much already know when to trade. And we want to start on the side of, okay, if this is happening, I don't even care about the market, or I'm staying out, or I have to add caution. And if it's not in one of these 3, so if I filter these 3 out and it's not in that, well, now we're in an actionable market and I can start thinking about framing a trade. So we're going to start here. And the first thing that holds up for me is the rule of avoiding Monday. And I do this already 95% of the time. And even when sometimes I'm looking for a trade on Monday, it either isn't offered to me or it just ends up in a losing trade. But I'll explain the reasoning behind avoiding Monday and why I continue to do this, and pretty much have always done this. The first reason is just based on data. Monday in itself is just smaller ranged on average from the open to close, the high to low. Just in general, it is a smaller range day out of all of the days of the week. And that's just one reason out of the few where I'm going to think about avoiding that, because I'm interested in anything that can put me onside more likely with an expansion day. I'm more concerned with that than anything. The second reason, which I think somewhat plays into this, but news can bring narrative into the market. It can bring certain volatility at times on these days. And Monday is always prior. It never has much news on the day. So it's really lacking that volatility that can be injected into the market. And that can sometimes be an issue when you want that for added confirmation, added narrative. And that's pretty similar for this as well, where the way that I view the market is every new week, I almost see that as a complete reset on the market, where sure, maybe I had a bias from the previous week, but when we open a new week, I am completely reassessing the market and I'm resetting my perspective. And when I do that, the weekly range matters in a way. And a lot of times the week will open where I don't really fully have a bias in mind, and I'm going to let Monday trade so I can actually look back on it. And what does that tell me about where I can go moving forward? So for example, here, this could be a previous week. I'm not holding any bias here. I want more context for Monday. And I'm going to allow that to trade, because looking back on what that does means a lot in my trading. So these are the 3 reasons generally why I'm avoiding Monday. And also it's a personal thing as well. So I added here, I would only be trading on Monday if you have some form of, you're journaling your trades, or you have something to say, okay, Monday, you don't perform poorly, or your trading is not impacted specifically just because it's Monday. That could be a reason to say, maybe for you, you can look at trading on Monday. Maybe it works for you. or your perspective is slightly different, I'm going to leave that up to you. But I'm going to tell you most of the times Monday is not of interest to me. I want to look back on it, use it as framework. And that's kind of why this rule is here. So caution protocol, if it's a Monday, I'm avoiding it because it usually does not bode very well overall. That goes into the next one. Similar to what you all know already from, I believe this is in the foundation model, expansion rule, when we're going on the daily time frame. So we're not thinking about confirmation here. We're not thinking about entries. We're just looking to frame a potential idea. And the expansion rule is a caution protocol because at the end of the expansion rule, we have to fully reassess the market, and we want to be a little bit hesitant because we can't continue trading a trend. But we'll talk about this here. What is the expansion rule? It's when on the daily time frame, we have 3 consecutive days of expansion in a row. Something like this: bullish, 3 consecutive days; bearish, 3 consecutive days in the same direction, no pause, nothing going on in between. And this is especially emphasized, and this kind of came up this week, when it occurs within a single week. That is when it's pretty extreme to be cautious on trading that continuation, because we expect the market at this point to pause or start trading back into the range. We don't expect a 4th continuation day, a 5th continuation day. We're going to take a step back, reassess the market, and apply a little bit more caution, because we have to now reframe a trade idea. We can't just keep continuing trading these to the upside or to the downside. That's why it's part of the caution protocol. And the only thing that you really have to think about is the 3 days in a row. It can't just be the close of the daily candle. So it can't just be 3 consecutive bullish daily candles like you see here. They need to be expansion days. And really what defines an expansion day, and I mentioned here, this is just a visual cue. You don't have to measure the days. You don't have to do anything fancy. An expansion day is going to open near the low, close near the high on a bullish day. It's going to open near the high and close near the low on a bearish day. It's going to be on average larger than most candles around it at that time. Something like this. These are obviously expansion days. But when you look to the right, sure, we have 3 up close days in a row, but these are not considered expansion days. If you look at the candle body, the bulky candle body matters because that shows the trend is holding throughout that candle. And that is what is a characteristic of expansion. So when you see something like this, this is not a valid expansion rule on this day here. It doesn't have to pause. It doesn't have to return back to the range. It could still trade to the upside versus something like this. And this did come up this week where here within the current week, that matters a lot more than when it's just happening in general. But we can see this playing out pretty consistently. Honestly, this is one of the most consistent rules of the market, in my opinion. When we have a new week, I would emphasize it there. 3 days of expansion. And today, the market just completely halts that continuation. It looks like this trend is never going to end. And then suddenly it pauses. Same with this. Tuesday, Wednesday, Thursday, the market just stops. It just stops in its tracks. And this is what I would be focusing on for the expansion rule. You can consider it when it comes outside of that, but really intra-week, that's going to be super significant. And for a day like this, that is coming into my bias on the market. And that expansion rule, it's really simple, but it's super effective when you view it in this way. And the third, caution protocol. So if it's not a Monday, you can look for a trade. If it's the expansion rule, you can't keep looking for continuations. You have to reassess the market. The third is when the market is in a neutral range. And this is going to happen when you look to both sides of the market and there are failure swings. So just like I talked about before, you can't really trade away from failure swings. If there's failure swings off the highs, it's tough to trade lower. If there's failure swings off the lows, it's tough to trade higher because those swings are not protected. We like to trade into these, not away from them. And when the market shows, this is going to be better viewed likely on an hourly time frame, 4 hour or 1 hour. When we look to the high, there's failure swings. Okay. If we're off the lows, there's failure swings. And then we reach back towards, if we draw out those 2 points and we draw towards equilibrium, you are now in a completely neutral market where both sides of that range are intact. and you don't really have a direction to trade into because neither of these sides are protected. This is that first sign of a neutral market. We can view it on a daily time frame as well. It's good to get an understanding of when you see certain daily candles, you can anticipate that they are likely failure swings just on a lower time frame, on like the hourly or 4-hour. This here, for example, like when I see this on a daily time frame and I see like closing near the high, but I assume this is not a reversal in this candle, but then the next candle, it doesn't really reach all the way up there. I'm going to assume that's a failure swing on an hourly time frame, similar to this where it's reaching down close to it. This is likely going to be a neutral market where you have to wait for one side to be traded to. And this really comes up again where if you see this condition happening here, you have to first look to a correlated pair to confirm that is actually a neutral market. So the same thing that you did, or the same thing I mentioned in the failure swing section, you look to both sides of the market. Okay, there's failure swings. Are we in a neutral market? Well, if you go to a correlated pair and one of them is showing a manipulation at that same point, suddenly this becomes a neutral market. This is a neutral market to not a neutral market. So if there's a divergence off the high, this pair manipulated, I can actually trade that lower because we can trade into failure swings and away from a protected swing. But if you don't see that when you view a correlated pair, that should be the first thing you do. Then it is a neutral market, and then you can move on to the protocol of a neutral range, which is going to be really either one of two things. You mark out the high or low, and you're waiting for one of those 2 points to get traded into. Does the market manipulate that point? Because again, that is a relevant level. Just like a failure swing, we're looking to that highest high or that lowest low. That's a relevant point in the market. You're going to ask, is it going to manipulate so I can trade it back into the range to the opposing side? That's pretty classic and what is ideal in my opinion. And what we're going to see here on a daily time frame is these can be traded intraday, but we're going to assume we're looking at the continuation and we reach up into one side of the range and the daily candle closes, it wicks that high, for example, on the daily candle. That's the first sign that you could look for. And then we can break this down to an hourly time frame. And likely within that wick, you could find some form of a change in save delivery on the hourly. And that would be enough to say that it's not continuing through that high, it's manipulating it. That would set for you to look to the downside or a continuation. The other thing we can look for is this especially is unlikely to be traded intraday. Because it takes time and we really want to see the daily candle closure on this. If we have the range set just in the same way, we're waiting for one side to be reached because anything internal is neutral. We close through on the daily candle. When you have a really aggressive move through that high, this is not showing willingness to manipulate. And then especially when we close aggressively through it, that's going to be the first sign that I could see this market continuing through that point. And if we go to an hourly, one way you can look for confluence on this, and a lot of times you're going to see, we go to a daily candle, we see this, and then we go to an hourly time frame, and we reach up into that high. A lot of times it's going to try to manipulate, or it'll pause around that area. And if we see a down close candle around that point after we've traded to that high, and we close through it, that's even added confirmation that this is acting as a continuation, and we are likely going to trade through the upside. This can happen on the downside as well. We close weak through this low and we trade the continuation. There's a few good examples of that recently, but that's really the signature that you're going to look for. So more emphasis on this for not trading it intraday. If you trade through a high like that, more likely you're going to want to wait for the following day because you want to see that daily candle closure and then get that confirmation again on the daily profile, because this rarely aligns with a good daily profile. You're going to want to wait for the following day. This here can be traded intraday, but it will really depend. Everyone understands that large wick rule, but this will come up in one of the following sections. But if it opened near the high, sure, that could be a fair thing to take intraday if you're trading reversals. So these are the three. If the market is not in one of these three conditions, then it is in an actionable market, and that's when you are looking for potential trades. So I think it's easier, in my opinion, to look for the negatives first, and then if it's not that, then we can think about trading. So these are the three there, and nothing too out of the normal for those three. I don't see any questions, so I assume everyone's fine with it. And we can go into an actionable market. And the only small adjustment that I made to this is because a lot of times I was getting questions on certain things, and I could see people doing some things that this should filter out, where when we're looking at the daily time frame, again, we're really focused here on the start, on the daily or the higher time frames, because we're trying to set a narrative or framework. We don't want to be looking so far back in the past, because as price goes on, especially when we're looking to frame reversals or just relevant points in the market, when we, for example, like this here, like this high so far back, maybe it means something, but when we look at really far old areas of price action, when we're focused on short-term opportunity, this is not as relevant. And I would prefer that people look towards more recent times, because that's going to have a larger impact on how the market is moving, at least in the short term. But it also filters out wanting to make really long-term predictions, saying, okay, this month or this is happening throughout the months, so the entire first quarter I'm going to be bullish, things of that nature, where we don't want to really be tied to these. We want to be able to be nimble in bias, and if necessary, going back and forth when needed, and not being too attached to any long-term bias. So I find that only looking 30 days back is plenty, and the only way you need to do this on your charts, if you hold shift and then drag on the daily time frame, you're going to get your 30 bars. So for example here, 30 candles back. If I'm looking for a point of reversal, that is way more than I'll really ever need. You can look outside of this for something like an objective or a draw. Like I can scale here because the market's trading into it. But when it comes to, I think the market's going to reverse here, or this is offering good framework, you really want it to be within the past 30 days. You can do this directly on your chart, or you can just have a general idea that this is what I would want you to be doing, and that would be the focus. So that's the only reason that's there, to kind of filter out doing anything that wouldn't really be aligned with the purpose of this model. Here we get into actual trade opportunities. So if the market is not in one of the three caution protocols, then we're in an actionable market. We can think about trades, because if something's not happening, that means something is happening, and we are looking for certain things. And for this here, just like everything else, we want to start on the daily time frame. If you notice, every time I go to a chart, I'm going to the daily. You don't see me drop to an hourly before looking here, because most of the time you're going to get everything you need from the daily time frame, but you have the option, if necessary, when more detail is needed, to go down to a 4-hour or an hourly for something like this. So an actionable market, this is pretty much taking the valid framework, is taking price delivery and making it more simple, where this covers expansion. You're already applying expansions. You're already applying consolidations, those two protocols, without even realizing it if you follow these two things. And then the only thing left outside of that is reversal or retracement. And if you go back to what those are, a reversal is just when you make a protected high and it is trading the other direction, a protected low when it's trading higher. A retracement is just when there's a protected low with an opposing draw to the upside, or a bearish retracement is when there's a protected high and then opposing draw lower. Like, it's basically the same thing. And if you follow this, you're going to be trading aligned with daily price delivery. So the only thing you have to really work on with this is, I think this is a super important skill that you have to build, which is understanding, if the market is not in one of these three things, where can opportunity occur from? And that's what this lesson is here. And I would say spend a lot of time with this here, because this is where we kind of go away from thinking about predictions on the market, and I'm focused more on, where does my opportunity exist? Is there already a protected swing formed? Am I near a relevant swing high or low that can be ran out and is going to offer an opportunity? That's really the point of this here. And I would really, like I say, spend time with this section, like this here. I'll kind of break down what this is showing, and let's pretend this is a daily time frame, because we're pretty much using your understanding of failure swings and protected swings to draw out where opportunity in the market exists. So this here, there's some explanation above that you can walk through, but I'll just show, I'm trying to give you the perspective of what I see in the market here, and you can forget the numbers for now. When we're here in the market, let's say this is a daily time frame, and I'm going to think, is there already a reversal established that I can start trading away from? Or is the market, are we near a point of relevance where there is an opportunity that's going to be offered? And this is similar to the neutral market, but this is just drawing out what is relevant and what I should focus on. So let's take this here. So the next day is going to be opening here. And I'm going to look left to say, has any of these previous days offered a reversal? This high here. So let's take this for example. Let's start here. We've ran out that high in candle 1. Candle 3's high ran out. But is candle 3 that extreme high? Is this a relevant high in the market? Well, when I look farther left, and that would be within that 30 days, this is just a failure swing to this high. So just like the failure swing lesson, because this is a failure swing to this high, this is not relevant. So when we run this out, I don't see this as a protected high. So I'm drawing this out because when I look left, this is the extreme. There's nothing beyond that point that I have to be concerned with. This is a relevant area in the market. If it were to run that out, manipulate, great. I have a potential valid framework. I can do the same thing off the lows where I keep drawing left and failure swing to this low. This could be a potential protected swing, but I have to ask myself, did it trade into anything relevant? And we look left, and again, this could be a failure swing to this low here. So this is not relevant. This is not going to hold in the market. And then I keep going left, and this is the extreme of that low. And you may ask, why is it not this low here? The way that I view these things is, let's say this low, you could call it a protected swing, but this low here, if the market were to run this out, because when we have swings in the market, the first general idea is a manipulation. If the market were to run this out, let's say it goes all the way down here and then starts trading higher, this will not become a failure swing to this low, meaning it doesn't become an irrelevant low, because there's enough distance between these 2 points that this is kind of outside of what I care about in that moment. If it's not going to create a failure swing to it, I can then consider this relevant. That is the extreme of that range. So this low doesn't matter, this low doesn't matter, this low doesn't matter, but this one does. In the same way that this high doesn't really matter, this high doesn't matter, we keep looking left, and this one does. Now, this is one of those things where you have to practice with this, because you're going to build an eye and just an understanding for what is relevant in the market. And it's, we can kind of do this with these here. So it's difficult when we're at all-time highs, where like this is the only relevant point. When I look left is, previous day high, because when I look left, there's nothing there. That's all I really care about. It's tough to gauge it at this point, but I could take my example from this here, where I took a long on this day on Tuesday. And the question is previous day low a relevant low, or is it just a failure swing to these other lows below? And to me, this is a valid or a relevant low. I can see it on the daily time frame, but I'll go down to the hourly even more so to draw this out, where I have an opposing draw. There's failure swings to the left. Great. That's a draw that I could be using. But this low means something to me, because when I look left, this is the next relevant point in the market. And I try to view things in just like a larger scale. So when I see these price swings, I see something like this, the low, the high, to the low. And this here, when it manipulates that, in this daily candle, is this low relevant? hundreds of points below, it's just not likely. It's just not relevant to that trading day, all the way down there. So this is relevant in my eyes. It's the extreme low where this is just not an area in the market that I have to concern with. And it's always in the back of my mind when I'm trying to draw out, is that protected swing valid? Did it occur at an extreme low or an extreme high? Or is the market near one of those points that it can run out for the following day? And that's really these two things. This is what you're going to have for a valid framework, is the market's basically going to be opening near one of those points, and it can make that small opposing run and then expand away. That's the first scenario you're going to have. The other thing is, and that's really only going to matter if you're trading reversal days. I know some people don't, but that's one scenario. And the other is just going to be, if that has already formed in the market, you look and say, okay, it formed a protected swing at that relevant point, and it's already started trading away while the opposing draw is still open. Well, it's just a continuation from that point, and there's really nothing else. That's pretty much where you're always going to find you're trading under one of those two things. It's either opening near that relevant swing and it can trade into it and it's a reversal day, or we're going to already have traded through it. There's going to be a protected swing in the market and you're trading a continuation away from it. And the opposing draw thing, you already understand this. Most of the time, we're just interested in trading into failure swings. So this here, I say spend a lot of time with it because this is gonna matter, understanding where valid points in the market exist. And this is price delivery here. Like I said, expansion's covered, consolidation's covered. This is just that, I'm giving air quotes right now, where reversal or retracement is just protected swings at relevant points or failure swings, and understanding what to do around those. So this here is an important section that I would spend some time with and practice in the charts. And the next thing, the weekly range. Again, this can be simplified into a couple things. And the weekly range, we're already doing it with the Monday rule, where we're not rolling over the bias. I'm going to look back on and let Monday trade without me. The previous week, the bias is not rolled over. Every Monday, every new week, I am resetting my bias and setting that narrative again. Profiles with the weekly profile. This, again, it's just the expansion rule. When you understand the expansion rule and you're already trading alongside that and you're avoiding Monday, you are basically trading weekly profiles. Because all of these profiles, if we look at them, classic expansion week, it's 3 days of expansion. Midweek reversal, 3 days of expansion maximum. Consolidation reversal, 2 days of expansion. Great. Thursday counter, 3 days of expansion. The market pauses or returns back into the range. They're all around that same rule. So if you're applying that and avoiding Monday, you're already trading weekly profiles without realizing it. And the only thing outside of this is when one of these profiles is not really relevant, or that expansion rule is not occurring, you're going back to, it's a non-profile. You're just going back to valid framework, because this rule is what creates weekly profiles. If that is not in place, then you are going back to valid framework. It's pretty much setting you right back here. So there's nothing overly complicated with this. And the weekly range, if you're just following the steps of this here, you are already trading weekly profiles without maybe even realizing it. Yeah, it's really that's really all it is. I don't see. Let's see, intraday confirmation. Yeah, so these two things here are the higher time frame, the narrative, avoiding the market. When do I have an idea that I have a potential trade? And that's what these two sections are doing. Start here. If it's not in a caution protocol, then we're here. Valid framework, weekly range, it all wraps into each other. So this here, there's really not much else to go through. It's pretty straightforward. And then if we have a valid framework, so you're only going to intraday confirmation if you have a valid framework, because that's what we need to have a trade. This applies to when we are looking for continuation days. We're trying to set that invalidation point, because reversal days, we don't have that, because it's just that valid framework where you're going to have a relevant swing that the market is opening near, and that's going to be your framework for the day on a reversal. But continuation days, we're going to look back into what the previous day did and find that invalidation point. So this is pretty simple. This is stuff you guys likely already understand. If the previous day had a large wick and closed near the open, then we can just say that we're going to use 50% of that wick here. So from the high of the wick to the low, 50% of that we expect the following day, if it's a continuation, to remain in respect to that. Same thing with bearish. Large wick to the upside. It's closing near the opening price. Okay, I can use that wick from the low of the wick to the high, 50%. We expect the market to set some framework in reverse on the continuation day below that point. Expansion days, again, if you're looking for the continuation, but the previous day was more of an expansion candle, meaning opening near the low, closing near the high, large candle body, just like we talked about before. Instead of using the wick, because the wick is small, you would use the entire previous day range. So from the high of the candle to the low, 50% of that, the continuation day to the upside and the following, should remain in respect to that, not trade really through it at all. Down close candle, bearish continuation from the high to the low, 50%. This framework on the continuation lower, this should not reach 50% of that candle. And you have an option when we do one of these two things. We can, if you want, break it down to an hourly time frame and refine that just a little bit more, where you have, this is that daily candle. Let's say this is an expansion daily candle, and we go into an hourly time frame. We have 50% of that daily candle here, but sometimes you can go to an hourly and you'll find opposing close candles above. So for bullish, above 50%, we're looking for down close candles. This here, we can refine that invalidation point because it's nested within that area. And we could even draw out the opening price if we wanted to. If the market reached into it, we would expect it to support price because it's opposing close candles in the continuation. So this is a way to refine it a little bit more. It's an optional thing that you can do. But if you want to keep it simple, you can just do the daily candle like this. But I do like to refine it a bit. I think there's a decent example. I don't know why I'm thinking of this, but I think Euro had some decent. Where was it from? Last. Yeah, so this is a decent, okay example here. So daily, this is Euro here. I just know we went through this on a live stream. So let's just say, okay, it's a range protocol. Cool. High, run that out. It's a large daily candle. So I'm not going to use the wick because that's not relevant. I can mark out 50% of that. And great, I have an invalidation point. I could stop there if I want to, or you can go down to an hourly and look at if there's opposing candles. Great, below 50%, there's up close candles. That should be in respect on the following day. So when we frame a bearish daily profile, expecting a continuation, I could refine it down or even see these as more relevant opposing close candles because they are, the other side of them are above 50% of that daily candle range. And then the continuation is there, just as a chart example. And the purpose of this is mainly because of that small wick rule. We're trying to be interested in expansion days. If the market reaches through that point, that means it's creating a large wick. If it's trading beyond that, it's making a large deviation from the opening price, whether it's a expansion candle as a previous, reaching down, or it's a reversal, it's reaching deep into that signature. We expect shallow retracements. So we want to see it occur above that point when bullish or below when bearish. So that's really the point of this, is that it's forcing you into only trading the small wicks, and it's forcing the market to respect that rule. And if it does, then you have a trade opportunity. And that's all it is. And that's the same thing with the valid framework, where if you're trading reversal days, and that is actually completely optional, some people may not want to, that framework is because we're interested when it's opening near that relevant point, because it doesn't need to deviate far to manipulate that. It can make a small opposing run and then expand away. Versus something like the neutral range, like this here, when it hits equilibrium, that means it's not really favoring either side. It's not opening near that point. So you don't really have a favorable side to be trading. Versus if it stays up here, never trades to equilibrium, well, then you don't have to really worry about this here. You're just interested in that high being read out. That's the relevant high. That would make more sense. But when it trades back here and this failure swings to both sides, you're not closer to either one to set a framework. So that's why we're more interested in the close proximity like this here as an example. And that would set your framework. And the previous day, of course, it applies to when you're trading the continuation. We can go down to intraday. So that's part of your intraday confirmation. That's setting the invalidation point. And then this here is when we're going to start getting into the confirmation piece alongside that invalidation point. And the 7-hour time frame is what we're going to be using for daily profiling. And this section here is just, you don't even have to look through it if you're not interested, but it's giving you some breakdown of why I'm using this time frame and the reasoning behind certain parts of it. So some data sets in here, and I'll go through it before getting into the daily profile part. So the 7-hour time frame, it's used to simplify the daily profile. And the main reason being why am I using this time frame is because it really does a good job of sectioning off what most would consider the 3 market sessions of Asia, London, and New York. So the first candle is, I'm going to be referencing this as the 18 candle. This is what some would consider Asia session. So from 18, these are Eastern Standard, 18 to 1 o'clock. The 1 o'clock candle, which is what people would consider London session, 1 o'clock to 8. And then 8 o'clock is the New York session, 8 o'clock to 15, which is basically the close. There's an extra hour in there, but that's just not really relevant. We're focused on the earlier hours most of the time anyways, so I'm not really concerned with that. So these 3 candles here section it off very well, and we can see this here. This is a measurement of the volatility across each candle, and it does a really good job of just sectioning it off. So the 18 candle, the open to the close of that, it's relatively lower volatility overall. It's always going to be like this. Most of the time, it's going to be less active price action. And then we get into the 1 o'clock candle, and I'll come back to this and it will start to make sense. The 1 o'clock candle, we have the 3 o'clock London open. So that's a market session open. You can see that first spike in volatility. That there, and that's kind of trends throughout the entire session. It's a little bit higher than the 18 candle. Relatively speaking, it makes slightly larger ranges. But then this is where we really get into the 8 o'clock candle where you see a massive jump. And this is likely due to, well, generally speaking, the New York session. We have 8:30 news. Many times we have the 9:30 open every single day if you're trading indices. But this here really does hold across most markets because New York is just where most things are being traded. 9:30 open, there's 10 o'clock news. Everything is really nested in these early hours and it holds throughout the day. So that sections it off really nicely. There's a little bit more here. So brief explanations. Yeah, the Asia session and the 18 candle, and no trading in here. We're going to get more into specifics there. The 1 o'clock candle is like London session, slightly slower. And the 8 o'clock candle is really where volatility starts to pick up. You see more expansions. And we'll get into some of these data points that you'll likely find interesting. The first is intraday reversals on expansion days. So when we filter out certain days to be expansions, that's what these fall under. And then an intraday reversal means a high on a bearish expansion day or a low on a bullish expansion day. So we're focused on that initial point of reversal. And the most interesting thing with this, which I was not aware of before, is the 18 candle making the intraday reversal 40% of the time. And before, I didn't really have a daily profile to go alongside this signature. It was a lot of discretion that came alongside this. So that's pretty surprising. The 1 o'clock candle, only 21%, and then the 8 o'clock candle, 39% of the time. You can see that distribution. That is, I used the wrong one for that, but that's perfectly fine. This is the image. I'll change that around. 40%, 21, 39. The next one is the amount of the total daily range. The 18 candle takes up 17%, so that lower volatility. This kind of correlates to that first image, 17% of the total daily range. The 1 o'clock candle takes up 24%, and the 8 o'clock candle at over double that does, or almost over triple, 59%, or about 60% of the total daily range. And you can see that distribution here if you were to envision a daily candle. Generally speaking, give or take, this is what you would expect from those 3 candles. And then if we go down one more, kind of bringing this all together, closes in the same direction of the daily candle close. So if the candle is bullish, does this candle also close bullish within that day? This here, the 18 candle closes in the same direction 58% of the time. So 50% to me is like, that means nothing. There's really nothing going on of interest there. So any big deviation away from that is meaningful in data. 1 o'clock candle, 62%. It's a little bit more. And then we get to 8 o'clock, 83% of the time, it closes in the same direction of the daily candle. That's pretty significant. And that's just when we kind of bring all these things together, majority of the daily range, 83% of the time closing in the direction of the daily candle. 40% of the time can make a reversal. You can see that difference here. It's really the candle or the hours where we either want to be entering within or I want to be holding a position through those hours. On average, that is going to be where I want to be participating. And then the 18 candle is usually where I don't want to be participating. And that's just some data points here. I'm going to flip these 2 images around when I get the time because they are opposite. But that's just some data on the 7-hour time frame. And it just helps to understand why certain things are the way they are. For this section here, the daily profile. And there's pretty much a daily profile for each of those candles to form a reversal, but it has to do it in a certain way alongside what your bias is to be valid. So for this here, you have an 18 reversal. This is that profile that can be traded. There is a 1 o'clock reversal. This is pretty classic, a London reversal, continuation here. And then there's a New York reversal, 8 o'clock candle, makes a low when bullish, a high when bearish. And these are the 3 profiles that we would be looking for alongside our framework. So, let's think of this here where small opposing runs from the daily candle in respect to either the valid framework or if it's a continuation day, that invalidation point. This here, if you're just following this process, these 4 steps, you're basically going to be trading daily profiles and you don't really need to get into the specifics. So I added what would happen in each of these. And I think the only one I'm really going to break down is this one here, but I gave each one its own section and a simplified sequence of what it would look like to trade that. But if you're following these 4 steps, you're basically going to be trading daily profiles. And the first is no trading within the 18 candle. So from 18 to 1 o'clock, no putting on entries. We're going to use that. We're pretty much treating it like a Monday in the weekly range where I'm going to let it print. What does it do? And can I look back on it to frame the daily profile? What is it giving me? And then I'm going to use that as context. And this kind of goes with the data too. It's unlikely to offer you a good move. It does make the reversal 40% of the time, but judging when that's going to occur is not easy when you don't have anything else to look back on. So we don't try to enter in this candle on average. So we're going to avoid trading in the 18 candle. And then from that point, some people aren't London traders. I understand that. So I'm just going to go with the assumption that you're always watching the market. Once that next candle opens, we're pretty much looking for, if the previous candle did not establish a reversal, then the current one should. If the current one did not establish a reversal, then the next one should. You're just rolling that over because you're just looking for that reversal to take place. Looking back, we're not trading in this candle. The only time rule base where we're not trading in this as well is, let's say we're bullish and during the open, there is a low in the 18 candle. In here, we are not trading away from that point. Reason being is because we do not want to try to predict that this is the low of the day. It's very possible that we could reach back down into it and then manipulate that to trade higher. And also this profile is reliant on these 2 candles. So without the close of this candle, we don't know if this low is going to hold in the market. So if you're bullish and there's an 18 candle low here, As long as that's intact, you're not trading. If you're bearish and there's an 18 candle high, as long as that remains intact, you're not trading in this candle here. We're waiting for that close because here we're going to look back on that. This is a valid profile, and I'm going to talk about this because it's the one that's a little bit different. This becomes a valid profile when, let's say we're bullish, it makes it low. We're not trading in this candle because if we're here and we look back on this candle and the market has already started the continuation, so we have deviated far enough from that low where it does not make sense for the market to trade back down, we are not going to expect it to do that. We are still bullish, and you need, as long as the opposing draw higher is still open, we're just going to look for that continuation signature in this candle here. There's plenty of examples if you want to go back to what that would look like when the market is breaking down or breaking higher. Go here, especially when the market's really expanding. So there's one that I traded myself. So we can look at these where, okay, we're down here and we're bearish. Does the market need to return all the way up here? Or is it likely that it's already in the continuation at this point? It's likely it's already in the continuation and I could trade that to the downside. Similar to these here, the market already starts to break. You can just trade the continuation. All of these, there's a lot of them here. Similar, 18 candle puts in a low, avoiding this. When we're opening here and we're expecting, the thing is we're expecting this candle to expand. It doesn't really have time to make that large opposing run and then make the move. This is going to take up the majority of the daily range. So if we've already broken away from that 18 candle low and it doesn't make sense to return, we're going to expect this to just be a continuation. And that really goes well for a lot of the times where the market is just heavily making that move. And that's the logic around this, why we're not going to speculate on it here, because when we look back, we need these two candles to understand if we can start trading this as a continuation. The only time that's not going to work is if it's pretty much this full invalidation where, sure, there's an 18 candle low, but it expands to the point where it either, one, runs out all objectives for the day. There's nothing else to trade into. Like, this is a very large expansion. Or two, it trades against you and expands through the invalidation point. That's when this profile doesn't work, because it's a full invalidation either way. It's when it breaks away just enough while you still have room open a trade to get on side with that. So that's this profile here. Other than that, it's really, okay, did the previous candle make the reversal? Is this a reversal? No, I'm going to roll it over here. It runs out the low when I'm bullish. I'm going to look in this candle if there's an initial confirmation. If it is, great, I can trade the continuation. Similar to this, 18 candle, I'm bullish, and I'm going to roll over to the next open here. Did the 18 candle reverse? Or I'm not going to trade it higher because there's a low intact, right? That's the rule. It didn't trade into that, so there's no established reversal. One, the market didn't break away from that low in this candle here, so we're going to expect in this candle here to run all of that out because a reversal has not taken place in one of the previous candles. It's really just that step. Did a reversal occur? If not, I'm rolling over to the next candle. And that's really the basis of it alongside that rule as well. And then you can go through these as well, where these other profiles, like what has to happen. Okay, the 18 candle is ranged or makes an opposing run. The 1 o'clock candle runs out the opposing swing of that candle. You have initial reversal and then continuation entries. You can read through these because it's just going to rephrase what I'm saying. But it's basically just, if you follow these steps, you are going to be trading alongside the daily profiles. So that's really daily profiling there. And you can read through, like I said, the specifics of each one within this here. But it's very simple with these 4 steps of what you're looking for. And then we're going to pair that alongside entry logic. This is the last part of getting on side with the trade. Within that daily profile understanding, we're looking for an initial reversal confirmation to a continuation entry after this occurs, because this model is going to be focused on entering in the continuation within either the 1 o'clock or the 8 o'clock candle. Time frame alignment, 1 o'clock candle. Think back to the data. It's a slower window of time. That means these price signatures have more time to develop. So time frame alignment, 30-minute and 15-minute within this time window. That means the initial reversal confirmation, 30-minute, 15-minute. The continuation signature, 30-minute, 15-minute. So both of them apply across these two time frames. The 8 o'clock candle, same with the data. It's faster moving. Things can occur and develop faster. Focus on 15-minute and 5-minute time frame alignment. And it's just because the market moves faster. And there's another thing in here with, I believe it's at the, yeah, I'll get into it. There's a little bit more specific with time frame alignment, but this is where you want to be focusing on these two here. So initial reversal confirmation, it's nothing that you don't already understand. It's a change in state of delivery that aligns with the daily profile. So off the low or the high, you're looking for that series or that single opposing close candle in respect to what those time frame alignments are to get that close through. And that's your initial reversal confirmation. And then your continuation entry. This is just like in the opposing candle section. The basis of this are just a bulky series or single opposing close candle that is closed through in the continuation. But we can add confluences alongside this. And the few things that we can do, a run on a short-term swing, a divergence at the opposing swing, opposing candle formed at a volatility driver, a close through occurring at a volatility driver, an opposing close candle in respect to other opposing close candles. So that's what you have here. So we can pair in the continuation, short-term swing, run that out, close above, confluence. Divergence at the low, close above, that's confluence. Stop will go at that low. Opposing close candles, either formed or closed above at a volatility driver, that's confluence, or in respect to other opposing close candles. These are things that we can bring together to make this a little bit more meaningful, and you can look for these alongside your entries in the continuation, again in respect to the time frames above. So we can have an initial reversal confirmation take place in the 1 o'clock candle, 30-minute to 50-minute. And then the continuation may take place in the 8 o'clock candle. So the continuation signature can be 15-minute and 5-minute. It doesn't have to all happen in the same candle. It's just whenever it does, you have to use the proper time frame alignment. And the time frame filtering, this is where you can kind of move a little bit more freely with the time frames. You don't have to fully restrict yourself, but the way that I view it is 1 o'clock candle, focus on 30-minute and don't drop below the 15-minute. But you can look at the hourly as well. It's very possible that that could offer a signature. 8 o'clock candle, a little bit more freeing as well. 15-minute and 5 is just a general where you're really going to want to be most of the time. 30-minute will have its chances to be relevant in this candle. There is moments where that will be used, and I would use it if it's offered. And then 4-minute and 3-minute, these are only to refine. If you're viewing something on the 5-minute and you see it developing there, but it's not giving you that clear signature, maybe there's a large wick, small candle body, and you want to get a better perspective, that's what these two are for. I wouldn't drop below a 3-minute. It's unnecessary and maybe pushing the boundary a little bit. The only rule here is start high time frame and then go top down. If you have the signature on the higher time frame, beautiful. That's what you take. There's no reason to drop lower. And then the minimum is don't force a lower time frame to try and, like, if you're not seeing it developing here, don't drop lower. That's forcing a signature that isn't really there. That's really the only rules around time frame filtering. But this is what I personally use when I'm using time frames. And then for entries, this is something I should have defined in the previous course, but I always use market entries. So when you are using closes through opposing candles, because that's the basis of what an entry will entail, close through, I don't need to use a limit order and wait for a retest. Once it closes through, that validates this low as protected, or a high if bearish. Once that closes, I can enter pretty much any time on the open of this next candle, as long as at that point my risk to reward is good, because my stop loss is going on that opposing swing every time. As long as my risk to reward is good, at the point of this opening candle. I'm not waiting for a retest. I'm not setting a limit order. I'm market entering in because there's going to be plenty of scenarios where that retest just doesn't occur because it's not a requirement. The market doesn't have to do that. So I don't enter in that way. I use market orders. If the risk reward is set, I'm pretty much in on that trade and not thinking much more beyond that. And the last section here, you go through all those steps. This is just your trade management. These here were in the foundation model, focusing on fixed point risk, not fixed, or focusing on fixed dollar risk. Fixed point risk is what we don't want to do, meaning you say you take an entry on a trade and it doesn't matter what type of setup it is. You're not adjusting to the volatility. You just, all your trades, you take 30-point stop losses. That doesn't work consistently. Some trades are going to need to use a 40-point stop loss. Some trades are going to need a 30-point, maybe less, maybe more. It's always changing. And we want to have our stop loss here at the correct area. That is the invalidation point. So we're trading the chart, not a fixed point risk. And this is what we want to avoid doing. This example shows you could get stopped out because of a fixed point risk where you should have still been in that trade if you had the correct stop loss. Instead, we want to use fixed dollar risk, meaning, and these are limit orders just being shown because it's easier to get the understanding across, even though you'd be using market orders. But let's say your fixed dollar risk, just in general, let's say all your trades, you're risking $2,400. And this is using NQ contracts, $20 per point. This trade is requiring you to use a 40-point stop loss. I'm going to take 3 contracts on that, and it's going to give me $2,400 of risk. This trade is different. It's only requiring a 30-point stop loss, and they're both at the valid areas of invalidation. Great. I'm going to use 4 contracts because it's still equal to $2,400 of risk. So that's what we want to be adjusting around, because your stop loss is always going to be at that invalidation point on the chart. And then there's some disclaimers. I'm not telling you to risk $2,400. And then it's using limit orders just because it simplifies what I'm trying to get across in this lesson. Just like the entry logic section, you use market orders. Objectives and scaling. This is very similar to the foundation model. We're still looking for 2R on these trades. That's really a minimum expectation. When you're lower frequency trading, we're kind of looking for a decent move. When we do all these steps, all that work, we want to get something out of it. And that is really what we're looking for on a trade idea. At that point, if we're hitting 2R, we want to be, let's think about scaling some off, half or more off of that position. That's that minimum objective. And then we can think about price objectives in the chart. Majority of the time, we're just thinking previous highs and lows. You can use daily, 4-hour, daily, like previous day swings, all of that good stuff. But even if you just go to an hourly time frame, and this is similar to what I was doing before, I'm just looking at the major swings that are relevant. And this is I'm just giving you where my eyes go, like how I'm viewing this. I'm looking at the relevant swings on an hourly time frame, and I'm going to be targeting things like that back into the range if I'm bearish, or vice versa if I was bullish. That's really just where I'm targeting. Anything beyond 2R, and that makes sense for me to scale at. It's really simple. It doesn't have to be overcomplicated when we have objectives, because we already have the narrative set. Now, if we're ever trading back into a range and you don't have lows established like this, maybe it's a large expansion range, and let's say we have a run on a high, we're trying to frame this bearish. When you don't have lows, there's obviously no clear lows to target. You can use 50%, so the highest high to lowest low. 50% of that range is a good area to be targeting, and anything beyond that is just like trade management. How far can I get that trade? This is not going to be as common, but it's here because there will be scenarios where you need to do that. Most of the time, just looking at swings on the other side of the market that you're trading into. Trailing stop loss. This is important stuff with trade management because this is more how do we systematically manage a trade without trying to introduce too much of our opinion or emotion. And the first thing we're going to be doing is being careful with moving stops to break even prematurely. So this rule here is trying to minimize the impact of trying to protect a position too quickly. So an example here where the market, you take an entry, great, it starts to work out. This is where your initial stop was. And it just kind of starts breaking higher. It's slightly in profit, but it didn't really reach towards 2R yet. and you try to protect your position at a little past break even, because maybe it makes you feel like you're protecting the trade, but you're not really allowing it to play out. We want to avoid doing this because the market doesn't know where you entered your trade, I should say. It doesn't see that as a relevant point where this is where your stop loss should be. That is the invalidation point. And until it either pretty much runs to your stop loss or hits a certain target, you shouldn't be messing with your stop loss much. And we want to avoid pushing trades to break even right after it just barely gets into profit. This is what this rule, and we'll get into some more specifics here, but as we trailing really starts after a trade is moving in profit. We have invalidation points. It's the same thing as anything else. You can look at the general rule of large candle bodies, a wide range. Once they close through, we can trail to the opposing swing, close through, opposing swing, close through, opposing swing, trailing that stop loss. Those are good invalidation points along the way as the market is continuing. And I like the 50-minute and 5-minute to do this. And this is one scenario that can occur on you when you are trying to manage a position. And I just call this discretionary management, because you are going to have scenarios where, like, it's so nice to have this because it's obvious where you should trail your stop loss. But there's going to be times the market just breaks away. And the first thing you should be thinking of when it's breaking away like that, sell into strength and buy into weakness and close that position out, because you're going to be getting good fills on that. Like, just start thinking about scaling. So the first thing is just favor scaling over trailing a stop loss, because you don't have any defined area to trail it to. The market isn't giving you that more mechanical sense. So favor scaling first. If it's at that point, sell into the strength, buy into the weakness. The other thing we can do is, sure, we'll probably already have some off the position at this point, trailing a stop loss in relation to risk to reward. So let's say if the market is here, I already have some of my position off, and there's still an objective open higher. Let's say it's 30 points above. I don't want to have my trailing stop loss 80 points below, because I'm risking 80 points to maybe get 30 more. That risk to reward doesn't make sense. So you can try to trail it where you say, maybe I have 30 points left on this trade, and it makes sense to risk 30 or maybe less to try and get there. There's no defined invalidation, but in risk to reward sense, I'm going to look to see if that is worth my time. And that's why we're really thinking about that after scaling, because we want to secure a position, or maybe you already close it fully into weakness or strength. But that is what you're really thinking about when this happens. And this is all about management here, trailing your stop loss. I think we're still looking for 2R on these trades. That's really where we're trying to push our trades to get to. But you can start thinking about doing things like this once your trade hits 1.5R, just to give you some more room where it did start to break in your favor. It's far enough, and before it does one of these two things, you are pretty much hands off. You're allowing it to do what the market needs to do. And then once it reaches that point, if it does, then you can think about these things here and trying to manage it to get to 2R, or you can allow it to run more. The only thing we just don't want to do is allow a trade that's up on us, especially when it's up like 2R. We don't ever want that to turn back and turn into a losing trade or a break-even trade when it's that deep in profit. Take your trade when it's at that point. Final section, this is a little bit new, but I've mentioned this before with your risk management. This is going to be personal to you in a few different ways, but risk management is going to be around having some data of understanding for your personal self, and it may change over time, but what is your maximum consecutive losses over a larger sample size of trades? And I say here, ideally, it's best to have this number if you have some past journal, or can input that and find what that number is for you, or you can back test it if you do it properly, like not in a way that's going to skew the number. And you want to be aware of what your maximum consecutive losses are. So wherever you are currently in your balance, and whatever some maximum drawdown, if you're trading a personal account, how much you're really willing to get down before assuming that you have to go into, or how much you can be willing to face and draw down. What is the maximum that you can take and still have a buffer to get yourself out of it. Let's say this example shows you have $5,000 to work with at that current point. You can take your worst over a series of trades was 5 trades in a row. That was the worst case scenario. Your risk management should be prepared for that. It's unlikely based on probability, but it is possible. And we want to be ready for that to happen. So you want to be able to take 5 losing trades in a row and still be able to get yourself out of drawdown in some way or another. So this is an example of that. And you just want to be aware of these things. So like, for example, if you were risking so much to the point where you take 3 losing trades in a row and you're completely knocked out, your risk is way too high. It's beyond manageable because you are going to have these times where consecutive losses just happen. You could be doing everything right and you're going to face, just based on random distribution of outcomes, you're going to find yourself in some form of a consecutive losing streak. That's just what happens, and you want to be ready for that. Similar to that, where some things are out of your control, an intraday rule, never taking more than 2 losses in a day. If that happens under a model like this, where it is usually lower frequency, we're trying to frame good confirmation and narrative. Either one, it means the day is just not going to deliver. Like, everything could be aligned. You do every step, it all looks perfect. Some days just don't deliver the move. Doesn't matter what you think, how good the framework was, it just doesn't do it. You want to be ready for that to happen. And if you take 2 losses, done. The other thing is that if you take 2 losses on a day or in a certain idea, it's just likely that you were wrong, and it's just better to move on and just reset on the next. So that should just protect you. This is just downside protection of certain things in the market are going to happen, and you just have to be prepared for that. Because if you don't do this here, it doesn't matter how good you are over this on this side. It's just all gone. Doesn't matter. So we need to do these 2 things right. And it's just for protection of the downside. So that is everything there.